Former VC investor Andrew Chen attracted more than 100 comments on his controversial LinkedIn article, saying the valuations of Kiwi startups are too low. In this week's Shoe Shine, Fiona Rotherham looks at 10 ways of fixing the problem. And Fiona, why is it that Kiwi firms suffer from the so-called New Zealand discount?
I mean, there's a number of reasons, but the primary one, the killer really, is the amount of capital out there for them. And there's this argument that good companies will always get funded, and that's true. And there have been plenty of examples where companies like Halter or Tracksuit have attracted big money and done very well out of the valuations. But in general, there's an argument that there's a lack of capital that means valuations here. Basically, investors get a good deal.
All right, so does it help, though, if they enlist the help of overseas investors or overseas experts?
I think it helps if they get some experienced founders advising them. One of the problems with, young founders is they don't know what they don't know. And they're also in the dark. A lot of this data around valuations and around what people are raising is known by the VC investors they're dealing with, but the founders themselves don't really have that experience. So getting someone on board, either as an advisory board or even hiring someone to help them out, can help them, so they're well armed when they go into these negotiations. I think getting some competition, trying to pitch themselves to overseas investors definitely helps lift those valuations. The New Zealand market's generally quite conservative. Obviously, they're looking for a good deal like anybody, and so if you can get some overseas investors who are used to paying more, then you can probably get a better deal.
Is there a risk though, of getting valuations that are a bit too frothy, getting ahead of themselves?
Absolutely, and I think there was a lot of evidence of that, particularly in the US. And you're seeing that now with some of the AI investments, because that's a hot market right now. People are jumping in. So if you get too far ahead of yourself, then that can cause problems further down the track in terms of, can you justify it? So it needs to be based on the fundamentals. But undervaluing brings problems too, because it means that if the founders get too diluted, if they haven't got enough stake in the game, then they're going to, they've got a long journey ahead of them from this early stage. So they need to have enough skin in the game to want to keep going. It's a tough job being an entrepreneur, and you've got to have the incentives there. And also, if they don't get enough money at the right valuations, it means they haven't got the resources they need to grow as fast as they could. So it can be setting them up for failure.
The government venture capital agency, NZGCP, they've put their hand out for another $500 million, just speaking in terms of the amount of money that is available in New Zealand. Would that help the New Zealand ecosystem?
I think there's pretty clear evidence that having a fund of funds, so Elevate provides funds to other VC funds, has helped in terms of increase the amount of investment at early stage. Some of the criticism is it's gone to some of the existing players rather than brought in, a lot of new players or helped the smaller players up. But certainly having that money there would be a definite boon.
You referred to it before, but do you think New Zealand firms need to get a bit better at promoting themselves overseas before they go out and do the raise?
I think any company needs to think about raising virtually from the start. I mean, the successful founders I've spoken to over the years, they start that conversation and that process early on with the people they think are going to be important to their company. So they're talking to them well ahead, saying this is what's coming up, this is our milestones. And so when they do approach, it's not such a cold call, and they've got more of a track record to show what they've achieved. It's really difficult at this early stage because they're pre-revenue, a lot of these companies, and so valuation is a lot more tricky. But I think if they've been selling their story, telling how innovative their technology is, having some proof to back that up, then obviously they're going to make themselves more attractive.
And look, it's almost the elephant in the room, but should KiwiSaver funds be made available to invest in this end of the market?
So the guy, Andrew Chen, who's a former VC investor who raised this issue about low valuations, that's what he thinks would be the single most difference in the market is having some of that institutional money, which is, growing massively as we speak, it's happened in Australia and made a very big difference to the market over there. So having even just 1% of their assets to alternative investment classes would be good. You've had some jump into the market. You've got, the super fund obviously at the top level, but also people like Simplicity have jumped in. But it's only a handful because it is high risk. So, you could argue, do KiwiSaver members want their money in high-risk investments? But definitely it makes a difference in terms of that pool of capital.
Fiona Rotherham, thanks for your analysis.
Thank you.
To support our award-winning independent journalism, subscribe to NBR kiwifounder.co.nz.